Invoice factoring and invoice financing. Invoice factoring and invoice financing are two types of financial services that allow businesses to gain early access to the money due from their invoices. Invoice factoring involves a business selling its outstanding invoices to a factoring company at a discount. The factoring company then takes responsibility for collecting the invoice payments. Invoice financing, on the other hand, allows a business to borrow money against its outstanding invoices. The business remains responsible for collecting the invoice payments, and the borrowed amount is repaid once the invoices are paid. Use cases. Both invoice factoring and invoice financing are typically used when a business needs to improve its cash flow. They can be particularly useful for businesses that have long invoice payment terms, or that have clients who are slow to pay. Differences between invoice factoring and invoice financing. The key difference between invoice factoring and invoice financing is who is responsible for collecting the invoice payments. With invoice factoring, the factoring company takes on this responsibility. With invoice financing, the business remains responsible. Best suited for. Invoice factoring and invoice financing are best suited for businesses that have a strong sales ledger but are experiencing cash flow issues due to slow-paying clients. They are often used by B2B businesses. Typical loan amounts. The amount offered for invoice factoring and invoice financing typically depends on the value of the business's outstanding invoices. It's common for lenders to advance up to 80–90% of the invoice value. Pros and cons of choosing this loan option. Pros of choosing this loan option. Improved cash flow. These services can provide businesses with immediate access to cash. Time saving. Invoice factoring can save businesses time on chasing invoice payments. No collateral required. These services typically use the invoices themselves as collateral. Cons of choosing this loan option. Cost. Invoice factoring and invoice financing can be more expensive than other types of financing. Dependence on customers. The business's ability to access financing is dependent on its customers' creditworthiness and payment habits. Potential impact on customer relationships. If a factoring company is responsible for collecting payments, their approach to debt collection could impact the business's relationships with its customers. Qualification criteria. Qualification for invoice factoring and invoice financing typically involves a review of the business's sales ledger and the creditworthiness of its customers. The minimum credit score required can vary by lender. Typical repayment terms. For invoice financing, the borrowed amount is typically repaid when the business's clients pay their invoices. For invoice factoring, there is no repayment as such, as the business has sold its invoices to the factoring company. Real-world example. Let's consider two hypothetical business owners, Sarah and John. Sarah owns a small manufacturing company. She has a number of large, reliable clients, but they often take 60 days to pay their invoices. Sarah uses invoice financing to borrow against these outstanding invoices, improving her cash flow and allowing her to meet her own financial obligations. John, on the other hand, runs a recruitment agency. He has a large number of invoices and is spending too much time chasing payments. John decides to use invoice factoring. He sells his outstanding invoices to a factoring company, which gives him an immediate cash injection and takes over the responsibility of collecting the invoice payments. In the next lesson, we'll learn all about use cases for merchant cash advances. If you like this video, be sure to check out the rest of our course on building business credit at mybusinesscredit.com.